and welcome to this week's look at the major news stories that have affected the market so far. And what are we going to concentrate on? Well, we're going to take a look initially at the FTSE 100, or UK100 as we call it. Had a pretty reasonable week, but obviously some big figures out on Thursday. Secondly, we can take a look at the Seng index, or the Hong Kong 50 at FXOpen. A heck of a couple of weeks for that, and we'll take a little bit more in-depth look on that one. Thirdly, we had an interest rate decision already this week, and that was out of Australia. So we're going to have a look at what happened to the Aussie dollar against the US dollar following the Bank of Australia's decision. And finally, we'll take a look at what's been happening in general to the US dollar against a couple of the other major pairs so far. The UK100, or the FTSE 100 stock market, was optimistic ahead of the Bank of England news. So Monday, we were shut in the UK for a bank holiday, so the UK100 or FTSE 100 was shut. But it was a pretty good day in the States for indices. So we opened up here Tuesday morning, and it was a very, very positive start to the day. The FTSE surpassed the 8,300 mark on Tuesday morning. In fact, it opened with a bit of a bullish gap, which tends to lead a little bit of confidence for a positive day. And the RSI on Tuesday morning was in overbought territory. That's the first time that's happened since early 2023. Now, it's worth noting one of the most significant drivers is due Thursday afternoon UK time, and that's the Bank of England decision on interest rates. And perhaps more important than the actual decision itself will be the following press conferences. As Econde writes, a decision to cut rates is unlikely on Thursday. In fact, most expectations are that the rate will remain unchanged, with autumn seen as the most probable period for a 0.25% or 25 basis point cut. Now, members of the rate setting committee are apparently concerned that inflation is slowing down too slowly. However, the trend is in the right direction, and the Bank of England has stated it doesn't need to be at the 2% target to start cutting rates. It's fair to say the words used and statements made after the decision could well be the most important aspect of the day, and it could well instill confidence in the bulls. But would it be sustainable? We take a quick look at the chart, and that shows us the price is moving within the long-term ascending channel, which is shown in blue. Meanwhile, the upper boundary, that's circa 8,500 level, could serve as resistance if the market sentiment remains optimistic, as it seemed to be earlier this week. On the other hand, of course, the price is vulnerable to some correction, and if that occurs, further resistance at 8,200 may provide some support. As shown by the violet lines, the successful tests of that form of resistance have happened previously, and that can underscore the bullish nature of the market. We'll circle around the 83.60 mark at the time of recording, but as I say, the figures or the decision and the statements made afterwards could be all important, so keep your eyes and ears open. Okay, second up, we're going to take a look at the Seng, or the Hong Kong 50, as it's called at FXOpen. Worth noting that with FXOpen, you can now trade the constituent members of the Hong Kong 50 via share CFDs, so opening up more markets for you as often as we can. Now, back in January, we published an article that the price of the Hong Kong 50 was near an important support level formed by the lower boundary that you can see in orange on the chart, which has been relevant since 1995. At the time, according to Reuters, Goldman Sachs representatives said in a client note that hedge funds were actively buying Chinese stocks. And from January the 23rd to the 25th, we saw the largest capital inflow in over 5 years. At the beginning of May, the price action suggests that these hedge fund purchases are and were justifiable, with the Hong Kong 50 up over 13% in just the past 2 weeks. So quite a significant increase there. What's it been driven by? Well, we've had economic stimulus from Beijing, certainly played a part. The Hong Kong Monetary Authority, the HKMA's decision to keep base rates unchanged at 5.75% also coming into play. The South China Morning Post reported that the HKMA's decisions correlate directly with the Fed Reserve's policy, and has done since 1983, reflecting the local currency's peg to the US dollar. Taking a look at that chart, what's that showing us? Well, the price remains in the orange long-term channel, and after fluctuations in January 2024 around the psychological level of 16,000, the price stabilised above there. Mid-April, The bears attempted to breach that 16,000 level again, but failed. If we take a look at the last two closed candles on the chart, they're bullish with quite wide bodies and some significant price action there, indicating demand dominance. Now, if the bulls do remain in control, the price could break above that upper boundary of the descending channel, which you can see in red, and open the possibility of a significant rally. Of course, there's also the possibility that we could see a correction after such a sudden and significant sized increase. Well, at time of recording, we're circa around the 18,630 mark. Could be a bit of volatility out there, so don't forget your risk management techniques. So we've obviously already spoken about the importance of the Bank of England decision on interest rates due on Thursday, but we've already had a decision this week, and that was from Australia. And the Royal Bank of Australia held rates at 4.35%, causing the Aussie dollar a little bit of weakness after that decision. Now, they did say that inflation is declining more slowly than expected, and the RBA Governor, Michelle Bullock, said things are reasonably balanced, with perhaps a signal that we need to be watchful on the upside. So not particularly strong statements about potential cuts in rates, and the absence of aggressive language is basically being contributed to a reduction in the price of the Australian dollar. Now, on the 8th of May, the Aussie dollar against the US dollar rate fell below the 0.657 level, which in fact was a decrease of approximately 1.3% in just 30 hours, compared to the 7th of May, a price of 0.664. So quite a sharp fall. The chart shows us that 0.664 serves as significant resistance. No real surprise there, and that the price may continue to decline, staying within the channel that we can see in red. Now, current bearish sentiment points towards a potential further decline in price towards that median line of the red channel, and support may be found around the spot 6555 level, where we also find the lower boundary of the intermediate rising channel, that's in black, and the 50% correction level from the impulse A to B, and also the MA 100 time frame. Now, we're not quite sure what's going to happen there. Obviously, a lack of firm rhetoric from the RBA has caused this bit of weakness, but we've got comments from the Federal Reserve due Thursday and Friday from the press conferences, which could well influence fluctuations in the Aussie dollar against the US dollar, as well as other US dollar denominated assets as well. So again, a lot of what's happening in the markets now has been driven by what's being said rather than the overall figure. So keep your eyes and ears open, and don't forget your risk management techniques. Okay, fine. We're going to take a quick look at what's been happening with the US dollar this week, particularly in relation to the Great British Pound and the Canadian dollar. Now, the GBP USD bulls have been struggling, whilst the US dollar against the CAD has regained some of its strength. Take a look first at cable. So that's the Great British Pound against the US dollar. Now, the hourly chart shows that the pound started a fresh decline from the 1.2635 resistance zone. In fact, traded below 1.2550 support level, and then below 1.25 the figure and the 50-hour simple moving average. A low formed around 1.2467, and then we seem to attempt a bit of a recovery wave, climbing above the 1.2485 level. We tested the 23.6 Fibonacci retracement level, and we can also see a key bearish line at 1.2500, which could provide us some immediate resistance. A close above 1.2530 might spark a steady upward move, perhaps as far as the 1.2635 resistance zone that we've seen recently. On the flip side of that, we've got support at 1.2465. After that, we could see it go down to 1.2440, and then perhaps a more sharp drop all the way down to 1.2350. Again, the rhetoric that's going to come out off of the Bank of England interest rate decision and statements by the Fed members coming up in the next couple of days are going to be quite major drivers here. Also, we'll take a quick look now at the chart for the US dollar against the Canadian dollar. And what does that show us? Well, we're forming strong support base above the 1.36 the figure level. The bulls pushed a pair above 1.3685 and then 1.3720 levels. We're seeing a high, or we saw a high I should say, of about 1.3760 on that chart, but we now seem to be consolidating around the 1.3720 level. The other side of that, we could see some resistance at 1.3735 and then 1.37 A close above that 1 spot 3760 level could well see us attempt the 1 spot 38, the figure level. Have a look at the flip side of that coin, that's support. Well, we've got the 50-hour simple moving average and then 1 spot 3720 in the short term. Then we could be looking at 1 spot 3685. Main support will be found near the 76.4% Fibonacci retracement at 1 spot 3645. Then we'll be looking a little bit further down at 1 spot 3610. Past here, we may well visit the 1 spot 3500 mark. Again, I've said it a number of times today, what is being said and how aggressive some of the statements about interest rates and inflation are in the next couple of days are going to be key. We wish you luck with your trading in the week ahead. Bye for now.